Welcome to the Tech Today podcast. It's your host, John Mayetta. We're very critical of the Federal Reserve and Fed Chair Jerome Powell. In fact, we just recently did a reaction video, which I loved, but unfortunately, it was found in violation of audio copyright by the folks at YouTube with respect to Paramount's content. So I don't know that I said too much that I haven't said before with respect to my criticisms of the Fed. It's just that I kind of like the way we put it together, and it was in response to Powell's recent interview with 60 Minutes, which was just before the CPI print from earlier this week. But nonetheless, we thought it makes sense to give Powell some constructive advice. So how would we manage Powell if we were both a combination of a strategy team? So if we could throw out all the Keynesian economists at the Fed and install our own policy, what would that look like? And then how would we position it? Well, the positioning is easy. We would tell the truth. And the truth would reflect our policy, which would be steadfast. Because right now, Jerome Powell looks a lot like the CEO who changes guidance, issues one set of guidance in January coming off of the Q4 call, takes the guidance down on the April earnings call, takes the guidance down again on the June earnings call. That CEO loses credibility with the street pretty quickly. Similarly, if you think about CEOs who they'll put forth one set of metrics when they report earnings, operating metrics, and then maybe those metrics take a turn for the worse, and then that company pulls back on those metrics and doesn't issue them any longer. And you don't see that happen too often. One example I could give you would be Apple. Some years ago, when it was clear that unit sales were stalling with respect to product sales, primarily the iPhone, and that growth was coming from price. The company just took unit sales numbers away. It no longer published those each quarter. So that type of thing will quickly lose you credibility with the street. And so if we were the Fed and Jerome Powell, we would give you the strategy, talk about the execution, and that strategy wouldn't waver. So first, let's look at, we have here Fed funds and how that's fluctuated over time. And now you're looking at the pre-COVID period in 2019 through sort of present day. Let's back up. Let's look at the 10-year. Let's back up again. Let's look at the 2000 period. So sort of pre the initial QE in 08-09. And this is sort of the environment I grew up in. Let's even go back further to 1990. And that's kind of how I remember Fed funds. If you look at this period from kind of the early 90s to early 2000s, 5-6% is where Fed funds kind of sat. And then we had the banking crisis of 08-09, and that's when the Fed took, not only did they take rates down to the zero bound, but they started to print money in order to exercise the very first QE program, where it bought fixed income securities to further ease monetary policy. Under my Fed, were I Fed chairman, I would much prefer to see steady Fed funds rate. So let's call it 3%. Some nominal Fed funds rate that we hold steady, whether the economy is on the weaker side or on the stronger side. We don't flex that Fed funds rate much at all. Under my monetary policy strategy, I would much prefer to flex the money supply as needed. I would prefer to, if we have a period like the Great Depression, when the Fed actually tightened policy and shrunk the money supply under weak economic conditions, I'd much prefer to expand the money supply. Let's look at the Fed's balance sheet here. And when the economy runs hot, that's when you would pull back and shrink the money supply, right? And the Fed is not doing this directly, although you're going to see the Fed engage directly with the economy through a central bank digital currency, which it will ultimately get around to issuing. And then the Fed will have a direct relationship with the public. But that's a story for another day. But in present day America, the way the Fed grows the money supply or shrinks the money supply is with the banks. So it extends credit to the banks, credits the bank balance sheets, and then the banks in turn issue loans, whether it be commercial loans or consumer loans. And so it's technically the banks that are growing the money supply, but it's the Fed that's printing money that extends credit to the banks, who in turn extend that credit to consumers and commercial businesses. So now, if we look at here's the Fed's balance sheet, and for the early part of my career, or for the first half of my career, more or less, the Fed ran its balance sheet under $1 trillion. Well, let's go back even further. Maybe I guess we're at max. So the Fed ran its balance sheet under $1 trillion. We have the banking crisis. You could see that in the midpoint around 2009 in that gray shaded column. That's the financial crisis. That's when the Fed first ran its QE program. That's when the Fed printed money to support the banks. And you can see the Fed's balance sheet doubled, getting just north of $2 trillion. And I remember when that happened, when Treasury and the Fed stepped in to the private markets. That was the first time in monetary and fiscal policy history that the fiscal side and the monetary side had stepped into the private markets in such a pronounced way that was not met favorably on the street. The Fed was already a big enough factor in the market, and here you have it exercising its heavy hand, as did Treasury. And QE was supposed to be a one-off program. But what's the saying is that there's nothing as permanent as a temporary government program, and we've had QE ever since. I believe we're taking a pause in QE. I believe it will return. I don't believe that we've seen the last of QE. The QE genie was let out of the bottle in 2008. And you can see they ran QE, and you had a period of about 6 years, 2014 to 2020, where the Fed's balance sheet hovered around 4 to 4.5 trillion, which is already a 4x increase over the pre-QE period. And so as if that weren't enough. And then what does the Fed do when things get tough under COVID? Well, it issues its own credit facilities. If you remember, there was a bond deal that Apple did that the Fed participated in. And then the Fed had all these various credit facilities for businesses that I thought just overdid it. The Fed, of course, subsidized the fiscal spending, the various fiscal programs under the CARES Act, including money that was mailed directly to Americans. The Fed, of course, subsidized that fiscal effort. And then, of course, QE was ramped up to where the Fed was buying 120 billion of securities per month, 90 billion of treasuries, 30 billion of mortgage backs. And compare that to the Fed's QT effort, where it's, in a big month, the Fed is allowing 50 billion of securities to mature off its balance sheet. So QE was much larger than the current QT program. And the aggregate effect of those efforts by the Fed in the COVID response period was to take its balance sheet from 4 trillion to, as you can see, um, peaking around 9 trillion at the end of Q1 2022. I'll narrow the focus here. And that's the Fed's balance sheet. And now, of course, it's allowed, as I said, securities to bleed off to a degree under QT. But in the meantime, let's see if I have it here on this chart. Yeah, here's the Bank Term Funding Program. So while the Fed's running QT, it's also running QE. Not the QE that we're all familiar with, but a version of QE known as the Bank Term Funding Program. So this is what the Fed initiated along with FDIC back in March of 2023, when the banks ran into a difficult time. The Fed added liquidity to the market. And if you recall, the way the Bank Term Funding Program works is the banks can borrow from the Fed. And the collateral that the banks use are the debt security investments on its balance sheet. And so if we go back to Fed funds here for a minute, when Fed funds was at zero, I'm going to go back to a 5-year view here. When we had this post-COVID period when Fed funds was at zero, a lot of banks gorged on debt. They bought debt securities as investments. And when the Fed started to raise Fed funds, given the inverse relationship that fixed income securities have between price and interest rates, as interest rates rose, the value of those holdings that the banks purchased at zero eroded the price value. So in 2023, when banks would look to borrow to raise liquidity, the value of that collateral had devalued as interest rates had climbed. And so when some banks were facing depositor withdrawals and they needed to raise liquidity, the collateral took such a hit, it was difficult for them to raise liquidity. And so along comes the Bank Term Funding Program, which allowed the banks to mark up the value of that collateral to par value. So it gave them full value for that collateral, and then it allowed the banks to borrow 100% margin on that collateral. And those terms were much more favorable to the traditional window, the traditional method that banks had from borrowing from the Fed, which was the discount window, whereby the borrowing rate, the interest rate charge of the banks was less than under the BTFP. The discount window did not mark up the value of collateral to par. Was not 100% margin that the banks could borrow against that collateral. So the Bank Term Funding Program was much more favorable to the banks than the Fed's discount window, which was the traditional method for borrowing. So now this Bank Term Funding Program goes away. So it's going to be fascinating to see how the banks fare in the absence of the Bank Term Funding Program when it expires on March 11th. So I went off on a bit of a tangent there, but the short story is we would have a monetary policy where the Fed funds rate didn't really move at all, and that we would control policy by flexing the money supply. And again, when the economy really starts to soften and you see a recession coming, that's when you would expand the money supply and allow the banks to extend more credit, make bank access to money easier. And then when the economy, you see it kind of running hot and there are signs of inflation or price increases, more accurately, inflation is when you inflate the money supply. But when you get the sense that the economy is running hot, that's when you would tighten policy and slow the growth of the money supply, or maybe even reduce, shrink the money supply on an absolute basis. I would much, much prefer that the market uh, be the one to set rates um, over the duration of the Treasury yield curve. And so I hope that was helpful. We'll have updates later tonight to the Fed's Bank Term Funding Program and to its QT effort when those numbers are released at 4:30 p.m. Eastern Time this afternoon. That's all for now. See you next time.